Good morning, everyone. Am I audible to all of you? Let me just confirm. Please send me a hi in the chat box and please confirm and let me know if my audio is absolutely clear to all of you. Good morning, everyone. Just give me 1 minute. I just want to set up the question paper also here. Yes, please type in the comment box if you are able to hear me. Am I audible? Let me just put a message just to confirm. Hold on. Let me just confirm that I'm audible, friends. Then only I can proceed. So students who are attending it live on YouTube, please can you send me a hi? Because I'm not sure if I'm clearly audible to all of you. The audio capture device says it's comfortable, but still for my satisfaction, I just want a confirmed reply from all of you. I just put a message in the group also. Give me a minute, and then we will start off with today's session. Okay. Yes. I am audible. I'm audible. I can just cross check that now. Good morning, everyone. I hope you're all doing good. Welcome to today's intensive session on CMA SFM Problem Marathon. So, what we are going to do over here is my objective of today's session is to crack a question paper for you in which we'll cover all the chapters, we'll be covering all the concepts, and I would like to make sure that these problems are presented in the right way. I have been training AFM and CMA SFM from the last 10 to 12 years, friends, and I'm happy to say that many of my students have also got an All India rank. Anjita from Kerala, Ashwini from Andhra, earlier she was in Chennai. All of these kids have got All India rank also. How they get this rank is in a very simple terms explainable is one, they understand the concept really well. Two, apart from this, they also get the presentation right, which is very important as far as a CMA SFM exam is concerned. So my entire effort today will be to explain to you the logic and the presentation. If these two things are in place, you can easily score very good marks in the examination, and SFM can be one of the papers that can help you to get much better marks and clear the CMA final examination. So shall we begin now, friends? Shall we start off? Okay, so today my objective is I will be discussing and solving this one question paper with all of you. Okay, hold on. It's a June 2023 exam paper. Okay, why I took June 2023 is because there's a gap in this, so there are always a chances that similar type concept questions will come in your December 24 examination also. If I take the immediate paper, if I take let's say June 2024, they will not put the same questions in December, and if I take December 2023 also, 1 year back means it is always has a less chance of such questions coming in the examination. So now what we'll do is we'll start off with this question paper now. Let us take section A. So in section A, it is more like an MCQ problems. Okay, but when we solve it, I will explain the logic also as to how the answers have come, and we will be solving it together. All right. So let me take question number 1. 1 1. So I just write down over here. Question number 1 1. So whenever we work out any question, friends, first and the foremost important point that's coming over here is you should write down the basic data. So I'll write down over here. Working note number 1, basic data. All right. So here when you check, this company is evaluating an investment of 39 lakhs. So I'll write down point number A, investment. Point number B, they have told the company is expecting a cash inflow of 6 lakhs per annum after tax. So cash inflow 6 lakhs per annum. All right. After that, they have told that the discount rate which it applies to investing decision is having a nature of how much? 14%. So discounting factor 14%. From this data, they are asking you to calculate your base case NPV. Can you please write down the basic data in your books? All right. So once you are done with this, let me explain to you the concept. Friends, NPV can be categorized into two parts. The first part is what we call it as base case NPV, and the second one is what we call it as adjusted NPV. The logic is very simple. When you take base case NPV, you take the NPV without considering borrowing. Because when you borrow money, instead of putting the money as investor, you end up paying interest. On interest, you have tax advantage. So tax advantage actually helps your company. Okay. So here we'll find out a very, very clean NPV without considering borrowing. So here what will I do? I will take the base case NPV plus I will take the tax impact of borrowing. That two together will give me what? It will give me my adjusted NPV. Everybody clear with this part? So considering this data in this question, they have not told anything about borrowing. So it's very easy for us. What will we do now, friends? We will just go and find out the normal NPV. So I'll write down working note number 2, NPV. What is the table format for NPV? Here, cash flow, discount factor and discounted cash flow. So year 0, what is your cash flow investment over here? 39 lakhs. What is the life they have told? Let's check. Indefinitely. So the cash flows are going to go on forever. So 1 to infinity, you get 6 lakhs. All right. Discounting factor is told as how much percentage? 14%. All right. So when you do like this, can you tell me here it will be 1? Now it is going for perpetuity. So what is the formula for perpetuity, friends? Cash flow divided by discounting factor. So 1 divided by 14% flat you will have to put over here. So tell me, friends, what is the answer you get over here? One moment. I just kept my calculator somewhere. I'll just arrange that. In the meanwhile, let me just do it in my mobile phone. Okay. So you get the answer as 7.14 into 6. So you get the answer as 42.85 and here it is 39. So then what is the final answer that you get over here? Do you get the answer as 3.85 lakhs will be your NPV? Let's just go and cross check if that option is available over here. Look, out of these 4, which one will be the correct answer, friends? Can you tell me? Yes, it will be 3.86 lakhs. Can you please write down this in your books? I'll just come in a minute, friends. Yes, friends, are you all done writing this in your books now? Can I go to the next part now? All right. So I think you got the NPV as 3.85 lakhs. Okay. So this part is clear. Shall I go to the second question now? By now you would have understood how to crack these questions. In this question, they are asking you calculate the least risky project if coefficient of variation is used. Okay. So I'll write down question number 1 subsection 2. Okay. So how do you find out coefficient of variation? I'll just give a heading. Coefficient of variation. All right. So here I'll write down first heading. I'll give it as project A, B, C and D. I'll put the NPV here and I'll put the standard deviation. Okay. Now what are the NPV for the first one? 1,20,000, 1,60,000, 1,40,000. And the last one is what? 1,80,000. Standard deviation is 8,000, 20,000, 24,000, 28,000. Okay. Now tell me, what is the formula for coefficient of variation? The formula is standard deviation divided by mean. So here it will be 8,000 divided by 1,20,000. So I'll get the answer as 0.066. 20,000 divided by 1,60,000, 0.125, 0.171, okay, 0.155. So when I rank it based on this, the logic is for every 1 rupee of average, I have this much of risk. So where is the highest risk? I believe 0.171 is the highest risk. Project C. Then we will go to project D. This will be the third one and this will be the fourth one. So what is the answer over here, friends? Can you tell me? It is going to be project C. Hold on. Down they have given completely different names. Project PQRT. It's supposed to be A, B, C, D. Sorry. A, B, C and D. So I think we got the answer as what? We got the answer as project C. Everybody clear with this part now? We can cross check the solution also here, friends. Let me take the solution so that we can double check and confirm that we have got the right answer. Two, they have given the answer as A. Hold on, project A. Sorry, they're asking least risky. I have given the answer as most risky. So let me just give a clarification over here. This is most risky. Project A is going to be least risky. So their question was what? Their question was least risky. So the answer is going to be A, friends. Everybody clear with this part? Okay. So we are done with question 1 subsection 2 also. Let us go to the third one now. Which of the following is not the component of digital infrastructure and why? Friends, it's more of a theory problem that has come for you. So API and integrations are a part of digital infrastructure. Cloud services are a part of digital infrastructure. All right. Stable coins is not, is what I understand. Let's double check. The answer should be C. Let's check. Yes, here also they have got the answer as C. So you can just put a note. Stable coins are not a component of digital infrastructure. All right. So we are done with 1, 3 also. Can I go to the fourth one now? Okay. Now, Mr. Patob, a portfolio manager managing a portfolio having a beta of 1.5. So I'll put question 1, subsection 4. Okay. In this, we'll write down point number A, beta. What is the beta that you get over here? 1.5. Okay. What is the current market value? Current market value is 12 crore. All right. It is expected that the markets are likely to correct downwards and hedging will be needed to be adopted for using Nifty index futures. What is the value of the current index futures? The value is turning out to be 8,000. Okay. Next part. With each contract underlies 100 units. Okay. From this, can I go and find out my contract size? What will be my contract size, friends? Do you get the answer as 8 lakh over here? Correct. Now they are asking how many Nifty futures should be sold. So they want a perfect hedge. Friends, in order to get a perfect hedge, what is the formula that we use? The formula that we use for perfect hedge is S0 into beta into 100 percentage. So here it will be 12 crore into 1.5 into 100 percentage. So I get the answer as 18 crore. Therefore, number of contracts that I will take will be 18 crore divided by 8 lakhs. Do I get the answer as 225 contracts over here? Now let us go and check if 225 is there in the option. If yes, then our answer is final. What is the question number we are talking about? Wait. Exactly. C. 225 contracts. Question number 4, right? So question number 4, the answer is C. Perfect. Are you all clear with this part now, friends? I'll give you a minute. Please write this down. All right, friends. Can I go to the next part now? Okay. So we are done with this question also. Let us go to question number 5 now. So I'll write down over here question 1-5. Right. Mr. Gorg is a forex dealer in India. The rates of rupee and euro in the international market, so I'll write down, is first one rupee spot. I think this is dollar bar rupee is given. Spot dollar bar rupee will be equal to 0.012572 dollar bar rupee. Friends, all these things are done in my regular class, so conceptually it's all very straightforward and clear. And euro is given, dollar bar euro is given. How much is that? 1.11 1.117294 dollar bar euro. All right, what will be his direct quote of euro to his customers? So basically from this data they want us to find out what will be the rupee bar euro quote. So how do we find out the rupee bar euro quote, friends? We have to do rupee bar dollar into dollar by euro is what will give you rupee bar euro. Am I right? So to get rupee bar dollar, they have given dollar bar rupee. I will have to do 1 divided by into dollar bar euro. Let's check. 1.117294 divided by 0.0 divided by 0.012572. You will get the answer as 88.87 rupee bar euro. Shall we check if that option is there available, friends? Yes, they have option number B. So for 5, the answer is option number B. Fantastic. We have got the answer. Can you write down this in your books now, friends? All right, friends. I think you're all done with this question also. Can I go to the next one now? All right, fine. So once you are done with this, question number 6 we'll take now. Okay. Question number 1-6. So here they have told plain vanilla interest swaps involve fixed to fixed, wrong. Fixed to floating, yes. Floating to floating, wrong. Currency swap is completely different. So what is the answer? B. Option number 6, the answer is B. Yes. Everybody clear? You move from fixed rate to floating rate. Friends, if you want to understand the logic of vanilla swap, if you visit my website, it is available over there. I'll just show you. You can just visit my website over here. Okay. And here you have this AFM free concept videos. AFM, SFM, the videos are almost the same. Okay. So if you go inside this, click down, you have interest rate derivatives. The moment you click here, you have FRA, IRO, IRF, and you just have to come down interest rate swap. This one video will explain to you the entire logic of interest rate swap in a very, very interesting manner. Okay, friends. So always you can use this if you want to get the concepts clear. In my website, these concept videos are given free of cost for your advantage. Okay. Now let's go to the next question. Okay. An option's theoretical value increases by 1.75. If the interest rate decreases by 1, then 1.75 is, this is a theoretical question, friends. I'll put it over here. Value increase. Interest rate decrease. Okay. First thing, value to interest rate sensitivity is found out using RHO. Inside RHO, you have two things. One, you have the call option. Second one, you have the put option. Call option comes in when value increases, interest also increase. Put option comes when value increase, interest decrease. So basically, if they move in opposite direction, it is a put. If they move in same direction, it is a call. Now tell me in this question, when you look at this, is it an RHO of call option or RHO of put option? This increase, other one is decreasing. So it will be the put option. Can you write down this in your books now? All right, friends, are you all done writing this in your books now? Can I go to the next one? Okay, fine. Now, intercept of security market line SML on the Y axis. One minute, let me just. Okay, intercept of security market line. What is the security market line? Everyone tell me. Required return is equal to RF plus beta into RM minus RF. This is the line. So when I draw a graph, the graph will go like this, where I'll start with, let's say my beta is 0, beta is 1, beta is 2, beta is 3. I'll start from here and the graph will go up like this. This graph is what we call it as the security market line. So here what they are asking is, we have two axes. One is the x-axis, other one is the y-axis. Now they are asking, what is the intercept of security market line on the y-axis? So friends, y-axis starts from here. Am I right? So this is the starting point, which according to me is the RF. Can we cross check the answer now? Question number 8. Answer is A. And I think that's the same thing that we got over here. Yes, RF. Okay, so here you can put intercept. This is your RF. Can you please draw this diagram in your books? Right, friends. Can I go to the next one now? Okay, let's go to question number 9 now. Okay, fine. 9 is a very good question. So I'll just write over here question 1 subsection 9. Okay, so now here Miss Bristry is considering an investment in a mutual fund with a 2% load. So first one is load is equal to 2%. Am I right? Okay. Now, as another alternative, she can also invest in FD at 8%. So, expectation that the investor has is how much percentage? It is 8%. All right. Her investment planning period is how many years? 4 years. Planning period is 4 years. All right. Now, what should be the annual rate of return on the mutual fund so that she prefers the investment in the fund to the investment in the FD? So, how much return she will expect? This is the question. Okay. Now, this becomes a little tricky because we'll take some random numbers. We'll assume, I'll just put a number over here. Assume 100 rupees is the investment value. We have done a similar type question in my regular class, okay, which I'll draw it and show you. Suppose this fellow has 100 rupees with him. He has two options. Option number 1, put the money in FD. There he will get assured 8% return, or he will get 8 rupees in hand. Correct? That he will get it for how many years? He will get it for 4 years. Now, instead of putting this money in FD, he is going to put the money in the mutual fund. So the problem what's happening over here is when he puts in the mutual fund, his investment from 100 directly 2% will go, only 98 will be invested. Okay. Now he should get some returns in year 1, year 2, year 3 and year 4, and then at the end of year 4 he should get back his money also. Are you getting my point? Okay. So when he is getting this, ultimately he should get the same return as what he is getting in the FD. So his expectation is what? 8%. I'll just explain to you by putting the numbers now. So year, cash flow, discount factor, discounted cash flow. Year 1, year 2, year 3, year 4. He is going to get, what is the return he is going to get in the mutual fund? I think that is not clearly told, and that is what we are trying to find out over here, right? Okay. So let me put it this way, year 1 to 4, at the end of year 4, he will get 98. His expectation is how much? 8%. Some money he will get over here. Alright. So once he gets his money, he should end up getting an NPV of 0. Okay. So how else do I explain to you? 1 minute. Okay, so here you are getting 8 rupees, and at the end of the 4th year you will be getting 100 rupees, right? Correct? So same thing you should be getting in this case also. Ideally you should be getting the same thing in this case also. So the present value, wait, or I'll put it in year 0, you're investing 98, your NPV should become 0. Let me work out like this. If you are not getting the answer, we'll rework the whole thing. Okay. 1, 2, 3, 4.735 will come over here, and here you will get 3.31. So 98, 3.31x. Here you will get 72.03. Okay. So the overall NPV from this should become 0. So when I say 72.03 plus 3.31x minus 98 should be equal to 0. So in other words, 98 minus 72.03 will give you 25.97, should be equal to 3.31x. So X will be equal to 25.97 divided by 3.31. That is 7.84 rupees should be your interest. Okay. Now the percentage, if you want to find out, you are going to get this on 98 rupees. So what is this divided by 98? You get the answer as 8%, friends. All right. Let me check if we have an option of 8% over here. No, they don't have an option of 8%. Friends, give me some time. Let me work out this question once again and I will make it logical and explain to you after the break. For time being, you keep this pending. I have made some mistake somewhere which I need to cross check and get back to you. Okay. Keep this one question pending. I'll get back to you, friends. Alright. Let us go to question number 10. Question number 10, they are asking you which one of the following is not a part of the market risk and why. Friends, market risks are risk that is involved in the stock market. So in the stock market, you have multiple forms of risk. So here they have given you four options. First one is equity risk, inflation risk, downgrade risk, and the last one is none of the above. So for this question, we are doing question number 10 now. The right answer is C. So C means here it is downgrade risk. Okay. So market is affected by equity. Market is also affected by inflation, but it is not, downgrade risk is not a part of the market risk, friends. Okay, so the answer is downgrade risk. All right, can I go to the next part now? Yes. Now that we are done with part 1, part 1 actually consisted of MCQ questions, friends. Now we'll go to part 2, which is more of an elaborate questions, friends, where you have very lengthy questions, but you have some good questions to be done. Can we start with question 2A now? Okay. So I will now write down question 2A. Ready? Alright. In this first one, what will I do? I will write down working note number 1, basic data. Alright. Now, Srishti is a manufacturing company, has machine Z, which is 10 years old. So what's the life of the machine? Life of machine Z. I think 10 years is enough. 10 years. Alright. Point number B, okay, is in need of an overhaul. So they are having the overall cost. So I'll write down over here, overall cost. So friends, how much is the overall cost? 17 lakh 50 plus 5 lakh plus 2 lakh 50. I think total will be 25 lakhs is your overall cost. Expenses can be capitalized and depreciated for tax purpose over the next 5 years with no salvage value. From this, can I find out the depreciation? How much will be the depreciation? 25 lakhs divided by how many years? 5 years. So do you get the answer as 5 lakh rupees per year? Fine. After you get the depreciation part, post overall operating cost will be as follows. Petrol, you're spending 17.5 lakhs, labor 15 lakhs, 7.5 and 5. So 20 and 25. You will be spending another 45 lakhs. So what I'll do is I'll put it over here, 45 lakhs. Running cost. ₹45 lakh. All right. This cost will increase at how much percent inflation, friends? 5% inflation. So I'll write down over here, inflation will be equal to how much percentage? It will be 5%. All right. Machine Z has a zero book value. So I'll go to the next part now. I'll put F. Okay, machine Z has a zero book value with the old parts, but it can be sold as it is for 2 lakhs, and the difference will be the values which will be charged at tax at the rate of 20%. So here they are giving second option. So I'll give it as a separate working note. Analysis of scrapping the machine. Hold on, friends. I think first, can you write down till here in your books? I'll wait. All right, friends. I believe you're all clear with the basic data part. Can I go to the next part now? So, scrapping up of machine. So, friends, when you scrap the machine, what is the sale value that you will get in your hands? 2 lakhs. Okay. But what will be your closing WDV? Sorry, friends. Your closing WDV will be 0. So, what will be the gain that you will get over here? 2 lakhs. On this gain, what will be the tax that you will have to pay? What is the tax rate they have told over here? 25%. So that will turn out to be 50,000. So what will be the cash flow after tax that you will get in your hands? Will you get 1,50,000 over here, friends? Am I right? Okay, so we got the answer for scrapping the machine also. Now let's read the next part. Installation of a brand new set of pairs. So now we have 3 options over here, friends. Let me first, can you write down this in your books, friends? Sorry, I'm forgetting that. Take a minute, write this down. All right, friends. Can I go to the next part now? Okay. Right. So I think once you are done with scrapping up of machine, I'll just give you the different types of options. What are the different options that are available with you? Option number 1 is you can go for overhauling. Okay. Option number 2 is what? Scrapping. Option number 3 is install brand new set of pair. So friends, this we have to find out NPV separately. This also we need to find out NPV separately. This also we need to find out the NPV separately. Everybody clear with this part now? So now I'll go to the next one. Next working note. Analysis of installation of brand new pair. Installation of brand new pair. So installation of brand new pair of parts instead of the overall of items of 1 to 3 above would mean a cost of 40 lakhs. So write down cost. What is the cost that you get over here? It will be 40 lakhs. Alright. With depreciation similar to overhauling. So depreciation means life will be 5 years. So 40 divided by 5, do I get the answer as 8 lakhs over here, friends? Right? Okay. This replacement will result in the following cost from the first year with an annual increase of, so here also we have an inflation factor to be considered. That is how much percentage? 5%. Now they have given you the following cost. fuel, labor 20, 32, 37. You have another running cost of 40 lakhs. 40 lakhs. All right. Let me come down. Then they have told over here, okay, overhauling or replacing will be done within a month. It will not impact anything. There is no scrap value. And they have told the cost of capital is going to be 10%. Cost of capital will be 10%. Can you please write down this also in your books? Then I will solve it. We'll find out the NPV for each of these options, friends. All right. So once you are done writing this, what we'll do, we'll go and write down the next to working note, NPV of overhauling. Okay. So here what I'll do, I'll draw a table here. Then I will put computation. From this computation, you will have cash flow, discount factor, discounted cash flow. All right. Year 0, what is the amount that you're investing in this thing? 25 lakh is your overall cost. No confusion on that. Year 1, your cost is going to be how much? Running cost will be how much? 25 lakhs will be the overall cost. Running cost will be 45 lakhs and you have a 5 lakh of depreciation every year, right? So here the formula would be 45 lakh of expense. On that, after tax, it will be 75%. Along with it, for depreciation of 5 lakh, you will have a 25% of cash inflow. Tax advantage will be there. 33.75, 1.25 minus, you will get 32.50 lakhs over here. Okay. Year 2, it will be 5% inflation. So 45 lakh plus 5% into 75% minus 1.25. Formula would be 45 into 1.05 into 75% plus 5 lakh into 25%. Year 3 will be 45 into 1.05 square into 75% plus, sorry, not plus, it will be minus over here. I'll just correct that part because it's a tax inflow and these are all outflows. Outflow minus 5 into 25%. So that will be 45 into 1.05 into 1.05 into 75% minus 1.25. That is 35.95. Year 4 will be the same way. I hope you understood what we are supposed to do now. 37.81 is what you will get. And then in year 5, it will be 45 into year 1, year 2, year 3, year 4, year 5 into 0.75 minus 1.25. 41.82. Okay. So once you put up all these things, from this we'll put a discounting factor of 10%. 1.909, 0.826, 0.751, 0.683, and what is the last one? 0.620. So let's multiply. Minus 25, 29.54, 28.23, 26.99, 25.88, 82, 25.92. So let's add up all these numbers. We'll get 161.51. Let's just cross check with the solution also, friends. 1 minute. Okay, they have got 160. That is just a rounding of difference, friends. All right. Yes. Can you please write down this in your books now? If you have any doubts, please do message me. All right, friends. I believe you're all done with this part. So we are done with the first one. Now I'll write down the next one. Okay. NPV of installing a new machine. Sorry, installing new parts. Okay. Now here also we'll have to draw the same table. Here you will have computation, then we will have cash flow, discount factor, and the last one would be a discounted cash flow. All right. Year 0. Now tell me, what is your investment over here? Is it 40 lakhs? Year 1, they have told you will have a running cost of 40 with 5% inflation. Depreciation is 8 lakhs. So I'll write down over here 40 lakh into 75 percentage minus 8 lakh into 25 percentage. So I think that is 2 lakhs, correct? So what is 40 into 75? 30. 30 minus 2, you will get the answer as 28. Year 2, it will be 40 plus 5 percentage. That is 42 into 75% minus 2 lakhs. You will get 29.5. Year 3, it will be 40 into 1.05 into 1.05 into 0.75 minus 2. 31.075, friends. Fourth one will be 40 into 1, year 2, year 3, year 4 into 0.75 minus 2. 34.46. Year 5 will be 2, 3, 4, 5 into 0.75 minus 2. 36.28. Discount factor is 10%. You have 1, 0.909, 0.826, 0.751, 0.683, 0.620. So minus 40, 25.45, 24.36, 23.33, 23.53, 22.49. Okay, so let's take the total now. 159.16 will be the answer. Okay, let's just cross check if it's approximately clear. Yeah, they have given 155. That's again a rounding of difference, friends. So you can ignore that part. Okay, so we have got 159 because we have taken all in two decimals. That's why a little bit of rounding of error is there. That's okay. You can ignore that part. Can you please write down this in your books now? All right, friends. I believe you're all clear with this part now. Okay. Can I go to the next one? One moment. Okay. All right. So I believe we are all clear with this one. Okay. So we are done with this. So which is better, friends? 159 is better, or how much came for the first one? 161. So which one is better? Installing the new parts is better. That will be the decision that they will be telling over here. Replacing parts is lower. Hence, you have to go for replacing the parts. Everybody clear with this part now? So we are done with this question also. Okay. Next, I have asked you what are the features of securitization, friends. So securitization has multiple features. I have taken this theory part in my regular class in a very elaborate manner. It will be difficult for me to explain theory right now. It is creating financial instruments that is nothing but loans. Okay, you can bundle the loans, like loss asset, substandard asset, standard assets, etc. And you can also unbundle them. You are using them as tools of risk management. It's a structured way of raising funding from outside. There is also something called as trenches, okay, where you break it up into different categories of loan and also based on homogeneity. Okay, right. So I think that part is clear. Let's go to the next question now. Question number 3A. Okay. So Soyan has an investment proposal requiring an initial outlay of 1,60,000. It has got 2 years life with no salvage value. Year 1, the price may go up or the price may come down. So we have to draw a decision tree. So I'll write down, this is question number 3A. Working note number 1. Decision tree. Okay. So now, how do you do the decision tree? You have an outlay of 1,60,000. Okay. Now, the investment is expected to have a life of 2 years, and in year 1, you have a 0.4 probability the cash flow after tax will be 1 lakh. So 0.4, it can be 1 lakh. Or I'll do one thing, I'll write down this 0.4 inside itself. Or 0.6, it might become 1,20,000. 1,20,000.6. Okay. Then they have told year 1, after year 1, year 2, you may get 48, 64, 88. 48,000. Then you have 64,000. And what is the last one that you have? 88,000. Okay. Friends, I think after this question, we'll take a short break and then we'll resume. Okay. You must be tired. We'll do this question and we'll take a short break. Okay. Then what are the numbers you get? 80, 1 lakh, 1 lakh 20. 1 lakh 20. All right. 0.2, 0.3, 0.5. 0.2, 0.3, 0.5, 0.4, 0.5, 0.1. So here I'll give a heading called as path, P-A-T-H, 1, 2, 3, 4, 5, 6. You have 6 paths over here. All right. So now what we have to do is once we draw the decision tree, we have to go by 4 steps. Step number 1, draw the decision tree. Step number 2, take the combined present value cash flow. Step number 3 is joint probability and step number 4 is NPV. So step number 1, can you please draw the decision tree? Yes, friends, I'm back. I hope you're done drawing this. So once you're done drawing this, then I will go to the next step. Combined present value cash flow. So here I'll write down path, cash flow in year 1, cash flow in year 2, present value cash flow in year 1, present value cash flow in year 2, total present value cash flow. All right. So here I'll write 1, 2, 3, 4, 5. We have 6 combinations. So year 1 it is 1,48,000. Sorry, yeah, 1,48,000. Next one is again 1 lakh. Third one is also 1 lakh. Okay. Other two are 1,20,000. Okay. Now, once you put this up, you have to put the year 2 cash flow, that will be 48, 64 and 88. 80, 1 lakh, 1,20,000. 1,20,000. So when I take the present value cash flow, it will be 0.909 into 1 lakh. 1,09,080. Okay. Now for year 2 it is 0.826. 39,648, 52,864, 72,688, 66,080, 82,600, 99,120. One lakh 43,773. 1,63,597. 1,75,160. 1,91,680. 2,08,200. Okay, so friends, out of these all the present value, can I say path 6 is actually turning out to be the best outcome and path 1 is turning out to be the worst outcome? Am I right? Okay, can you please write down this in your books now? All right, friends, I believe you're all done writing this. So once you get the combined present value cash flow, the next step what we write down is joint probability. Okay, so here again I'll put the same table, path 1, 2, 3, 4, 5, 6. We will put probability in year 1, then we will put probability in year 2, and then from these two things we find out the joint probability. Okay, so now tell me, when you do this, what was the probability for the first one? 0.4, 0.6, correct? So I'll write 0.4, 0.6, okay, and then other one is 0.2, 0.3, 0.5, and the other one is 0.4, 0.5, 0.1. So when you take the joint probability, it's multiplying both. So you get 0.08, 0.12, 0.20, 0.24, 0.30 and 0.06. Total will be 1. So this is the next step. Can you quickly write down this also in your books now? Yes, my AFM mastery is useful for CMA SFM students also, because everything is the same. Whatever we are doing here, everything is done in my class. It is done in my mastery book also. Fine, friends. So once you're done with the joint probability, now what will we do? We will find out the expected cash flow, and here itself we can also find out the NPV. So I'll again put the table path combined present value cash flow. Then I'll write down joint probability From this, we can find out the expected present value cash flow. 1, 2, 3, 4, 5, 6. So first we'll put the cash flow 1,35,57. Second one is 1,43,773. Third one is going to be 1,63,597. Fourth one will be 1,75,160. Okay, next one is 1,91,680. And the last one is going to be 2,08,200. And your probability will be 8, 12, 20, 24. 8, 12, 20, 24, 30 and 6. Sorry. Alright, so now here it will be 1,35,57 into 0.08 will be 1,04,444 into 0.12 will be 17,250. Sorry, I made a mistake. 17,000. Okay, so there's a mistake in the first one. 10,444, friends. Sorry. Okay. 1,63,597 into 0.2, 32,719. 42,038. 57,504. 12,492. One lakh 72,449. Once you get this answer, your NPV will be present value of cash inflows minus the present value of cash outflow. How much is the initial investment that they have? 1,60,000. So what is your NPV? Plus 12,449. NPV being positive, the project should be accepted. Can you write down this in your books now? All right, friends, are you all done writing this? So once you get this, we are actually done with this problem. Okay, you would have got the expected NPV of 12,447. We got the same answer. Now they're asking if the worst outcome is realized, your NPV will be how much is what they're asking. So we'll write down that now. Next one, analysis of worst outcome. Okay, now tell me, when you have the worst outcome, what was the outcome that you had? 1,30,557, correct? 1,30,557 minus you had an investment of 1,60,000. You get the answer as 29,443. Okay. Now, what about the probability for this one? What about the probability for the worst outcome? Let's go and check. Path 1 has an 8% probability. Same way, we can also do analysis of the best outcome. Analysis of the best outcome. So now tell me, when you're doing the best outcome, what is going to be your this thing? 2,08,200 minus 1,60,000, that will be 48,200. And what will be the probability of this? Probability will be, let's go and check, 10%. Sorry, 6%. Can you write down this also and finish it off? All right. I believe all of you are done writing this also in your books now. Okay, fine. So once we are done with this, okay, I think we are done with this question also. Can we just check what more are there to be done? So we can just take a session, we can take a break and then we can continue. I think we have 4A, then we have 4B, mutual fund question, then we have a 5A, we have 5B, okay, 4, then you have 6A, 6B, so we have 6, 7A, that is 7, 7B, 8. We have 8 more questions, friends. Section C is not applicable to you anymore. So what we'll do is, we'll take a break now. After the break, we'll resume with our session, okay? And in the next session, we'll do these 8 questions at a stretch and we'll try packing up our session with that itself. So I think by around 2 o'clock, 2:30, we'll wind up our session. Is that okay with all of you, friends? Okay. So I'll see you after the break. Okay. I'll be putting the link again in the group and we'll be proceeding with the same thing. Thank you so much.